So if you've been following us for more than a year, you know around April last year, we covered 5 companies that we think are quite interesting as high dividend paying companies for 2024. Now we are going to do 2025's version today. Too busy to find stock ideas? Check out FIRL Pro to shortcut your research time and effort by 90%. 10% off link in the comments and description. Before that, let's look at the performance, right, of those 5 companies. So the dividend yield is actually decreased, right, for Hong Leong Industries. FPI, Harrison, United Plantation, and Tech have not really announced yet. However, one would expect it to be lower for these dividend companies. So as you can see, even though these 5 companies are actually really high quality, the dividend quality can actually deteriorate in the span of a year. And that is why a business is very important, more important than what is the dividend yield.
Yep, exactly. And also you want to take note for financial year 2024, there was a front loading in terms of paying out dividends because the 2% dividend tax. That's why you can see that some companies like Hong Leong Industry, actually even United Plantation, they all declare like special dividend. So that's why, even though they declared special dividends, so like United Plantation is actually around 4%. And the reason why is because it's at 4%, the share price actually went up even more. So that answers it. So so number one is that there's a lot of front loading. And also number two, 2 of the companies that we covered last year, they're going to be facing quite a
big business headwinds.
Correct. So because these 2 are like related to the exporting market, so we covered about them. We already talked about what is their risk and all of that. So if you are interested, you want to watch the entire analysis, you can just click the links over here. Okay, so that being said, there is going to be a new list for financial year end 2025. And the first one, we're still going to be maintaining Hong Leong Industry, which their dividend yield is about 5.93%.
They're really stable, relatively stable business.
Yes, correct.
Not without its challenges, but that's why it's back,
Yeah, it's a Yamaha motorbike. So I think the Malays also like Yamaha motorbikes a lot. But also there's some sort of risk. Although you can see that the motorcycle sales is actually growing as compared to last year. The risk is, however, is the Chinese player that is coming inside here. But their market share is kind of like very tiny. But we also have some insights from our FIRL Pro members. Some of them are actually a motorbike enthusiasts. So they did share that the Chinese bike is actually at a lower cost and also the quality is actually better or maybe even on par Yamaha. So that can actually be some sort of risk for Hong Leong Industry in the future. But that said, if the government restricts they place like certain quota number of like motorbikes coming from China to Malaysia, then maybe Hong Leong Industries market share position may be retaining. But other than that, if there's more Chinese sales coming in, then it will definitely impact their business and also their dividend payout. But you also can see that so far, this company has been maintaining about 80% payout ratio. And also you can see their profits also have been quite stable. If you look at this blue color line over here, this blue color bar. So purple color bar. So it's actually pretty decent. And assuming they can maintain it, the yield you're looking at is actually around 7% at this current price point. So that's the first one, which is Hong Leong Industry. Second one, which is
palm oil.
Palm oil / bulking / security document distributor, all those kind of things.
Yeah, a bit of a conglomerate-ish, right?
Exactly. So now, on first glance, you would think that how this company is going to pay out their dividend, because if you look at some of these numbers, right, they are number one, the free cash flow, which is the orange color bar, it's going down. Number 2, they are in the net debt position. You can see previously net cash, but the debt is going up. Then net income also okay, decent, but then it's like going up and down and up and down. It's something like a cyclical kind of like thing. So here is our argument. So the first one is they are actually in a net cash position if you exclude out the lease liability. This is some sort of like a accounting treatment. You guys can actually just Google whether you should add lease liabilities into your calculation for net cash. Most of the analysts or even accountant, they will just exclude lease liabilities and they just only take the borrowings into consideration. So this net debt position is actually in a net cash position. Second one is that they are actually spending a lot of capex, which is why their recent free cash flow has been bad. And they has been spending like about, I think, cumulatively around 300 million in capex to actually open out additional capacity for their bulking business. So if you guys didn't know, their bulking business is something like Dialog like that. So they have like storage space near the port. So they put it in North Port and also in Butterworth Port. And they are adding more capacity. And also this port, right, is actually very limited in supply. So they realize that, there's more trading going on. There's more like ships are actually like exporting oil, exporting palm oil, all these kind of things. So they need more storage to be near the port. So that's why they are actually building more of that, which means you can expect maybe in the future's free cash flow might be even better because they are actually maintaining it, replacing the new handlers, and also expanding the capacity over here. So this could be a once-off. Last but not least is this company's payout ratio is about 20%. So, and if you see that their profit is about 120 million, right? And if you actually do the calculation, their dividend yield based on the payout ratio, it's about like 6 to 7% dividend yield. So that's actually pretty attractive for Kumpulan Fima. Okay, the third company is MHC. So this is a plantation company, and if you see this star sign over here, it's because this is a 2024 number. They haven't really distributed out for financial year 2025. Okay, so MHC is very simple. You need to acknowledge that they are in a cyclical industry that is related to plantation. So which means you also need to see whether these CPO prices can actually maintain. If let's say it start to drop, then obviously their profit will drop. And the last but not least, obviously CPO prices will affect their profit consistency. So right now, plantation, we think that it's actually still having like a good outlook. At least for now, I mean, there's no signs of like increasing in supply. And assuming demand actually maintains, CPO prices at current price point will likely to maintain or maybe even go higher. So that means that MHC's plantations, profit will go up. And then let's say if they maintain their payout ratio about 30%, it's also going to be a very attractive yield, probably even 7 to 8%. Okay, fourth one, Valesto. So I have a disclaimer. We own Valesto.
Yep.
Yeah. Just to share with you guys. So why the Valesto, right? And obviously this one is about a 7% yield for 2024. 2025's number will be coming soon next year, February 2026. Okay, so why this company? So if you notice their recent dividend payout is actually increasing over here. If you compare 2023 to 2024, and then this 2025's number is actually only just first payment. They haven't really released a second payment yet.
So I mean, if you prorate, it's...
Yes, correct. So the first payment is already 3x already compared to last year. So yeah, the next payment we don't know. But anyhow, why they are paying out or starting to pay out dividends is because they did this capital reduction. And they also did say that, we want to actually, I think it's the first time that I'm reading it, but they want to like give back to shareholders. Yep. Which is very good. I mean, they're actually taking care of minority shareholders. And also they did say this in their website. They basically say that we want to return our free cash flow to our shareholders, build a more stronger capital position, and everything seems to be very interesting for Valesto.
Yeah, so there's a few contributing reasons, and some of what I say might be partially speculation, but the first is that PNB is a large shareholder of Valesto. So, PNB needs dividends to pay their unit holders. So, people want to run together. Then the second thing is the company is also in a phase where they do not want to reinvest a lot anymore. The market that they are in, which is, I believe, JU rigs, right?
Yeah, correct, rigs.
So these rigs, they lease these rigs, right, for usage. And the market is not booming, so there's not a lot of people entering the space. But because it's not booming, so people are not really spending any capex, including Valesto. When you look at what they do, they are not super sensitive to oil prices. So, rain or shine, oil majors or their clients will still need their services on a consistent basis.
Yeah.
So you have a relatively consistent kind of business, not a lot of market entrance, no capex that people intend to spend, plus PNB, there's institutional, let's call it, encouragement to pay more dividends. And so what this means for the minority shareholder is that more money is coming your way. That is why the dividends can increase.
Yeah, exactly. And assuming, because right now the oil prices is quite depressed level, right?
Yeah,
assuming it even goes up,
jumps,
right?
Yeah.
So, oil companies want likely to spend more, and which means they need even more of services.
That is a catalyst, that potential, but we don't bet on it. I think whatever thesis you have on Valesto should exclude oil price hike. It comes, then yay, thank you, right?
Yeah, exactly. Okay, last but not least, this is a dark horse, it's an underdog, which is Aeon Credit, and we also did cover about this company just a few days ago, so you can watch it over here. And if you look at the yield, it's about 5%, but this yield is 2024's number. They haven't paid out for 2025. So the thesis for Aeon Credit is that, number one, if you look at our final thoughts about this company, is that they are going through like some sort of like cycle whereby the management is pretty much of they want to grow their loan a lot. So when they try to grow their loan, obviously their asset quality also start to deteriorate, which is why they are incurring a lot of these higher impairment losses. But assuming, let's say, this management realize that this is a huge problem and they don't want to continue this problem, right? So they may actually start to take a handbrake and then maybe even introduce like other measures to counter it, to be more conservative in a sense. So hopefully this is basically like a down cycle. And let's say if they go back to normal, because right now they're paying about 28 cents a share of dividend. Let's say they go back to normal like 40 cents. At current price, it is actually looking very juicy, which is about like 7 to 8%. Of dividend yield. Now, remember that previously we talked about they are about 4.96%. So the future yield is assuming they start to turn around things, then probably it's going to be about 7 to 8% yield. So the final thoughts over here, obviously, is that the past results is not equal to the future. I mean,
not always.
Yeah, I mean, you can see our 2024's video on the dividend stocks, right? Most of the stocks actually didn't manage to
suffer.
They suffer and they didn't really pay out consistently because of external forces.
Yeah, and which leads to point number 2, right? Which is cash flow sustainability. I think we tell people who are more dividend oriented all the time, right, that you need to find a company with a solid business model with recurring cash flows and preferably growing. And I think one of our members in our research team said that the best dividend stocks are growth stocks. You want to guess why? Because if earnings grow, it's more dividends available. On the assumption that management actually cares, right? So a company can grow, but management doesn't want to release the money, then it's too bad.
Yeah, which is the third point over here, whether management, they want to commit in continue paying out this money. But assuming like suddenly they decided to change their mind or they slept in the wrong side, then that's too bad already.
Yeah, that's why I think if management has 2 things you want to look for, like how, the question might be asked, how can we predict that management is like that? I think 2 things. The first is the management has skin in the game, significant shareholding. So when they pay the dividends, they're getting money as well, right? And the second thing is there's a lot of institutions involved. They will want, especially the EPFs, the PNBs, the QUAP, things like that. Then the likelihood of it happening is a lot higher. Now, sometimes it can be to a fault. So, like for example, one company I want to bring up is Globetronics. So Globetronics in the tech manufacturing sector is often known as a good dividend payer. Why? Is because it's owned by a lot of institutions, right? But the bad part is because they keep doing that, then the business starts to suffer. Then they never reinvest, and so now Globetronics is struggling, right? In fact, I've not looked at their price for a year, so I wonder what they are at now. But anyways, so that's why you have to balance this too, right? It's not always good to pay out all their dividends, right?
Yep, exactly. So last but not least is whether we shall revisit our predictions in the future. So if this video gets about 300 likes.
Yeah, 300 likes.
Yeah, then we will do a future video on 2036, and let's see whether we can actually, or whether these companies can manage to maintain their dividend payout, or maybe even increase, or maybe we change a new company. Who knows, right? So yeah, that's about it for today's video. And before you guys go, this is our FIRL Pro's July
August
update.
Will be a lot better.
Yes, so make sure to look forward to that. And for those who actually joined during August, right, I think you guys also should manage to get some of the juicy ideas that went up quite a lot, like 10-20% for a few stocks that we just recently initiated. So if you want to know what are the stocks behind all of these portfolios, right, you can actually check it out inside FIRL Pro. It's a place where we actually do our analysis on companies we find interesting, and we share with you guys about their business model, their prospects, the risks, the management, a lot of juicy informations that might not be exclusively available to the public. So if you want to get all of these insights, it will be inside FIRL Pro. And if you want to get a taste, you want to see how we do our write-ups, we have actually a few samples for you guys over here. The links also will be in the description and comments. And just to share with you guys, this is Dividend over here. It's a company that we covered, I will say, 3 years ago, 2-3 years ago. And we bought it over here and we sold it at around like a 50 to 60% gain. And not only just Dilium is inside, KGB is another company that we also did initiated over there. And so far it has been doing very, very well. So if you want to read about it, you can read it inside the free sample. And that's all for today's video. See you guys next week.
Bye-bye.